New depression. Is the worst of the economic collapse over? Not really. The economy is on the bottom, but this can only be expected after the historical crash in March-May and the stock market crash in March and April. Now the question is not whether we will grow again. The questions are how fast is this growth and how long will it take us to return to 2019 output levels. And this question is not only valid for the United States, but for the entire global economy, especially for major manufacturers such as China, Japan, and EU. The news here is not good at all. Recent data show that may not reach 2019 output levels by 2023 at the earliest, and that something close to full employment may not return until 2025. A simple example will touch on the point. Suppose GDP 2019 has a normalized level of 100. Let's assume a 10% drop, about how much the US economy will fall for the whole of 2020 according to many estimates. This takes the comparison to 90 in 2020. Now, suppose a 5% growth in 2021. This will also be the highest growth rate in decades. This will move the benchmark back to 94.5. Then let's assume that the growth in 2022 is 4%, which will be a record annual growth in the last 30 years. This takes the benchmark to 98.3. Here is the problem. An output level of 98.3 is still below 100. In other words, back-to-back growth of 5% is 2021, and 4% in 2022 is not enough to improve the 2019 level after a 10% drop in 2020. However, the situation is even worse than I have described. The Chinese PMI figures have recently been 50.9 production and 54.4 services. The Wall Street happy-speaking brigade applaud these numbers because they exceed expectations and show growth. Any number above 50 indicates growth in a PMI index series. However, growth is fully expected. The problem is that the growth is too weak. A strong return from a crash should produce 60 or 70 PMI readings if a solid recovery is underway, not. The truth is that what the US economy is currently experiencing is much worse than a technical recession. A recession is defined as 2 or more consecutive quarters of reduced growth with high unemployment. The National Bureau of Economic Research, the special mediator on when the recession started and ended, declared a recession that began in February. Judging precisely by growth figures, the recession may have already ended, but we won't know the coming months until quarterly growth figures are available, and NBER has time to consider them and make a call. Most recessions don't last that long, usually only 6 to 9 months. But this misses the fact that we are really in a new depression. You say, wait a minute, the growth may be weak, but it's still strong. How can you say we are depressed? As I explained earlier, the starting point for understanding depression is to get the definition right. Economists do not like the word depression because it has no exact mathematical definition. There is nothing available for economists that cannot be quantified. This view is one of the many shortcomings of the modern economy. Many consider depression as a steady decline in GDP. The standard definition of a recession is, as I just explained, 2 or more consecutive quarters of declining GDP and rising unemployment. As depression turns out to be something worse than a recession, investors think it should mean an extra long period of decline. But this is not the definition of depression. The best description ever presented came from John Maynard Keynes in the 1936 classic the general theory of employment, interest and money. Keynes said that depression is a chronic subnormal state of activity for a considerable period of time, with no apparent propensity towards recovery or complete collapse. Keynes did not mention fallen GDP, he talked about below normal activity. In other words, it's entirely possible to grow up in a depression. The problem is that the growth is below the trend. It is weak growth that does not do the job of providing enough jobs or standing ahead of national debt. This is exactly what the US is experiencing today. The key is that depression is not measured by declining growth, but by a combination of actual declines and recovery below trend. This happened during the Great Depression. Between 1929 and 1932, there was reduced growth and a technical stagnation, then a recovery from 1933 to 36 low level, then a second technical recession in 1937 to 38, followed by another recovery between 1939 and 1940. The entire period of 1929 to 1940 is known as the Great Depression because the stock market and commercial real estate never regained 1929 levels until 1940. They eventually recovered in 1954. Depressions are also categorized by larger behavior changes, including higher saving rates, smaller family size, and internal migration. These effects are intergenerational. From the 1930s, many behavioral challenges were still common in the 1950s and early 1960s, and lasted until the aging of baby boomers in the late 1960s. This kind of profound change with lasting effect is happening again due to the spread of COVID-19 compound, business failures, urban riots, and failed mayors and police departments, which are spreading in densely populated areas. Millions of Americans are migrating from major cities to suburbs and countrysides. American families are leaving dysfunctional cities like New York City, Seattle, and San Francisco and heading for Montana, Colorado, Maine, and the Catskill Mountains north of New York, among other safe havens. Big cities have always struck a balance between higher taxes and urban stress in exchange for entertainment, great restaurants, museums, and intellectual buzz. The venues and buzz are gone today, crime rates are rising, and all that's left is stress and taxes. So people are dating. Changes like this are not temporary. When people move in, they never come back. Their children might come back one day, but it could be a 15 or 20 years away. And those who leave tend to have the most capital and the most talented people. This leaves the cities empty, bullets filled by the oligarchs with their personal bodyguards, and the poor who have to deal with street-level violence. This change can be beneficial for individuals on the move, but is devastating for the economies of large cities, and this is devastating for the US economy as a whole. Even if the technical stagnation ends soon, it's another reason we have been in crisis for years. The best case is that it will take years to return to 2019 output levels. The worst case is that the output drops further when recovery fails. We're not really in a recession right now. We're in a depression and will stay there for years. No one under 90 has ever had depression. Most investors have no idea what depression is or how it affects asset values, but they will learn, and probably the hard way. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.